In a previous session, we talked about the defined benefit pension plan, and we said that one of the major features of that was that at the other end, the consumer, the client, the employee, whatever, knew exactly what they were going to get at the other end. The sister product to this, of course, is the defined contribution pension plan, so DCPP, okay? So defined contribution pension plan. So this is the kind of opposite, you might say, to a defined benefit pension plan. And sometimes you may see the word in literature or whatever, they call it a money purchase plan as well. So sometimes referred to as a money purchase plan. But the legal name is defined contribution pension plan. Okay? The benefit amount, in other words, the amount that comes out at the other end, 65, whatever age, okay, depends on a number of features. The main thing is contributions, okay, how much money was actually put in there by the employer, by the employees, in other words, how much in actual fact was contributed, okay? And the second part of it is the investment income. When we invested that money, did we have a decent return on that money, okay? So therefore here, what happens is that the employee, okay, doesn't really know the amount of retirement. In other words, I can't tell you that, yes, you stay with me to age 65 and I'm going to carry you $4,000 a month for the rest of your life, okay? If you recall that defined benefit plan, I could say that. I could say, look, you do this, this, and this is what's going to happen at the other end. And so therefore, as long as you perform your duties, you're going to get that check. Here, I really don't know what that amounts. So the disadvantage here of the defined contribution pension plan is that it's very difficult for you as the employee to really plan your retirement, because you don't really know how much money you're going to have at the other end. Because a lot of it, like I said, depends on how much money actually went into the plan to start off with, and also the investment return. So if we go through a very a period of 10 or 15 years, for example, or we go through a deep recession or whatever it is, and you've got your money basically in the market, and the market tanks, okay, and you now are 65 and you want to take that money. So instead of having a big bag of money, you only have a small bag of money. And you're basically stuck, because that's it. It's nothing else. So in a defined contribution plan, pension plan, I don't guarantee you anything, okay? So basically, the employers basically say, I will contribute my piece, you contribute your piece, okay? We'll see what happens. And at the other end, if it's great years, we'll have a big bag of money. If it's lousy years, we're going to have a small bag of money. There's nothing I can do about that, okay? So there's no guarantees. On the plus side, okay, the employee can decide how and when to, how and where or how and when to actually invest. So unlike, again, defined benefit pension plan, where you never had a choice in terms of where you want the money invested, this was all done by the employer, this plan sponsor, basically. So you never got a list of options and everything else. So would you like your money invested and all that? That didn't happen, right? On a defined contribution pension plan, basically you have to make some decisions here. So you need to talk to your advisor and all that sort of thing to see whether, depending on your risk tolerance, this, that, and the other, you'll be able to invest money accordingly. So here you do have the option basically of managing your money through the advisor, through the plan sponsor, basically managing that money. Whereas the defined benefit pension plan, like I said, that option was not available to you. So this is really very much of a money purchase or deposit type of plan. Okay. There's also no waiting period. So if you remember again with defined benefit pension, we said it has to vest after 2 years. So it might, you might get it immediately. They may start the plan immediately, or they may say, no, you have to be working for us a certain amount of hours, a certain amount of time before we will allow you to participate in the defined benefit pension plan. With the defined contribution plan, there is no waiting period. Basically, whenever you start, and that's it. And it is primarily for full-time employees. Very, very rare. In fact, I've never seen one for part-time employees. Most of the times it's for full-time employees. Okay, so in terms of those contributions that we just talked about, okay, the employer must contribute. In other words, this is a must. So the employer must put in some money. As to the amount, that again is negotiable depending on the sponsor, all these things here, okay? But the employer does have to put in at least $1, let's say, into the plan. So this is not employee pay all, okay? This is a contributory plan, so there's no option here. So therefore, the employer must contribute. The employee, on the other hand, is not mandatory. Okay, so this could be a situation where the employer only puts money in and that's it, but you as the employee do not. It's kind of rare, but it is possible. So it's not mandatory, although most plans will say, yes, I'll put in my dollar, you put in your dollar, that kind of stuff there. Important to note is that there is no past service. Okay, so there's no PA. And there's no past service pension adjustment. Again, unlike defined benefit, where if you recall, there was a pension adjustment, there was also a past service pension adjustment and all that. In other words, you were buying those credits, you were catching up on those credits. Here, it doesn't exist. Okay, so there is no PA, there is no past service pension adjustment. You start contributing money, and that's it. There's nothing. There's no credits to actually buy. Okay, it's just simply a deposit account, and that's it. Okay, and the limit of the how much you can contribute to defined contribution pension is actually set by the Income Tax Act. Okay, so it is, but most of the times it's 50% of whatever your RSP contribution would have been basically for that particular year. So it is very much set by the Income Tax Act. So once again, you have to look at your plan document and everything, make sure that you know what your limits are and everything else. Okay. The real critical issue here is that the benefit is not guaranteed. In other words, I can't turn around and say to you, you work for me for the next 20 years, 30 years, whatever it is, you put all this money in, the whole bit, and at the other end is going to be this much money in the pot. I can't say that. All I can say is put all this money in, and then when the day arrives at age 65 or whenever you decide that you want to start your pension and everything else, whatever that bag of money is, we'll take that and we will go then and buy you an immediate annuity. And so we will talk about those annuities, the kind of annuities in a different session and everything. Okay, but the point I'm getting at, okay, is that I can't give you any kind of guarantees here. You're just going to have to sort of hope and pray that there will be a certain amount of money left at the other end. So when you get that bag of money, basically now you go to an insurance company and say, I have this bag of money and I want to buy an annuity accordingly and everything else, and they will then take care of you from that. But unlike a defined benefit, I can't tell you what and how much money you're going to get at that end. So it's very difficult to plan. This is the unfortunate part. But nonetheless, that's what it is. Now there are some employers, of course, who have both. They have a defined benefit pension plan and they have the defined contribution. Usually what happens is, like for the unionized people, for example, there will be defined benefit. For the non-unionized people will be defined contribution. In some cases, could be that the employer says for existing employees, they will continue to have the defined benefit, and for all brand new employees, there'll be defined contribution. So there could be a combination of both. And then again, you have to look at your plan sponsor and see what the stipulation is. Regardless of which way you go in all of this, because once again, it is registered money, the entire amount of money that you get at the other end, once again, will be taxable. So you need to do your tax planning accordingly. Because once again, as I've said, when you're talking about registered money, the ACB is zero. So any amounts of money you take out from these particular plans will be taxable income in that particular year. So depending on your marginal tax rate, you've got to pay the appropriate amount of tax at that point. And we'll leave it there at this point. See you soon.